We would like to welcome you to the Stefanutti Stocks Annual Financial Results webcast for the full year ended 29 February 2020. This presentation is available on our website. These results are not influenced by the effects of COVID-19. I'll address the impact of COVID-19 on the business later on in the presentation. I would like to start the presentation with an update on the funding. During the current reporting period, Eskom has adopted an adverse approach to certification of applications for work done, which has required a substantial increase of internal funding for the Kusile building project. This has contributed towards an increase of the initial funding requirement of 400 million to approximately 986 million. Of this, 725 million relates to the Kusile building project. Including the estimated impact of COVID-19 of 270 million, the total funding requirement for the group is estimated at 1.25 billion. In accordance with the restructuring plan, the lenders have provided the group with total funding of 1.25 billion from July 2019 to date. These funds have been utilized to meet the group's short-term liquidity requirements, which allows more time for the group to resolve its contractual claims and compensation events on the Kusile power project. I shall now discuss the restructuring plan. As previously reported, a strategic restructuring team has been appointed, including the appointment of a chief restructuring officer, to advise on and assist with the development and implementation of a detailed turnaround plan for the group, including the securing of requisite additional short-term funding from the lenders and the subsequent restructuring of all short-term funding into appropriate long-term funding. Shareholders are advised that the restructuring plan has been fully developed, including having regard to the potential impact of COVID-19 on the group and its businesses. The plan has been approved by both the company's board of directors and the lenders and envisages, inter alia, the sale of non-core assets, the sale of underutilized plant and equipment, the sale of certain divisions or subsidiaries, internal restructuring initiatives required to restore optimal operational and financial performance, the securing of additional short-term funding of 430 million, of which 270 million relates to the initial impact of COVID-19, a favorable outcome from the processes relating to the contractual claims and compensation events on the Kusile power project, the restructuring of the short-term funding received to date from the lenders into a term loan, and evaluation of an optimum business model and associated capital structure analysis, including the potential of raising new equity. In line with a restructuring plan, management has started to reconfigure the group's organizational structure to improve operational performance and decrease overhead costs, including the reduction of the group's overall headcount. The restructuring plan is anticipated to be implemented over the financial years ending February 2021 and February 2022, and to the extent required, shareholder approval will be sought for relevant aspects of the plan. The previous short-term funding agreement was converted into a term loan on 1st of July 2020, which loan terminates on 28 February 2022. And in addition, the lenders have agreed to provide continued guarantee support for current and future projects being undertaken by the group. This term loan carries the normal terms and conditions applicable to loans of this nature. Stefanutti Stocks will continue to update shareholders on progress on various aspects of the restructuring plan. Eskom-Kusile power project. As previously mentioned, due to Eskom adopting an adverse approach to certification of measured work on the Kusile building project, and in addition to the provision of 263 million raised at February 2019 for the potential unrecoverable preliminary and general costs, the group has now raised a further provision of 462 million for potential unrecoverable monthly measured works to complete the project. We have considered Eskom-Kusile contract investigation status briefing document and note that Stefanutti Stocks disputes that it or the joint venture operations in which it participates have been overpaid. The group is pursuing a number of contractual claims and compensation events, and that the investigations being carried out by and on behalf of Eskom are not complete. During the period 2015 to 2018, payments made by Eskom were all consequent to certificates issued by the independent engineer, who together with Eskom audited the records and satisfied themselves that the costs claimed were actually and validly incurred in the construction of the project. Stefanutti Stocks contends it is owed additional amounts in respect of work done since December 2018 and in respect of which payments have been withheld. Stefanutti Stocks and Eskom have both committed to a claims resolution process which involves the appointment of independent experts to evaluate the causes of delays and quantum thereof. This process remains ongoing and is anticipated to be substantially resolved by February 2022. With respect to Package 28, during February 2019, Eskom terminated the contract with Stefanutti Stocks Izazi JV due to their inability to provide access to the contractor to complete the relevant works. Based on the works completed, as well as Eskom's termination of the contract, we contend that there are material amounts due to us. We had already commenced an adjudication process in 2018, which is anticipated to be concluded during the latter part of 2020. I shall now cover the key indicators. The continued adverse market conditions, as well as the substantial impact of the Kusile power projects, has reduced contract revenue from operations to 8.6 billion when compared against February 2019 of 9.9 billion. The group incurred an operating loss of 1.033 billion when compared against an operating loss of 158 million in February 2019. The influencing factors on the operating loss will be discussed in more detail on the next slide and later in this presentation under the respective business unit reviews. The group's current order book in June 2020 is 8.5 billion, of which 4.2 billion arises from work beyond South Africa's borders. The order book is 3 billion down from February 2019. The financial indicators will be covered by Antonio later in this presentation. Management and staff remain committed to enhanced health, safety, and environmental policies and procedures, and together strive to constantly improve the group's health, safety, and environmental performances. The group's lost time injury frequency rate at February 2020 was 0.02, this being the same as in February 2019, and the recordable case rate of 0.29, an improvement from the 0.36 in February 2019. The group continues to be a level 1 broad-based black economic empowerment contributor measured in terms of the construction sector scorecard, with a black economic interest score of 58.1%. At the next verification in August this year, we expect the black economic interest score to improve. I would like to give context to the operating loss. Provision for future costs. The IAS 37 provision of 462 million, as mentioned earlier under the funding update, has been raised for potential unrecoverable costs for measured work to complete the Kusile building project. This has negatively impacted the results of the building business unit. Provision for slow-paying trade receivables. Due to less frequent and reduced payments being received from certain local and cross-border clients since the beginning of the financial period, specific provisions have been raised to the value of 331 million. The recovery of these amounts will continue to receive management's full attention. We have recognized receipt of some of these funds in the restructuring plan. Project losses. During the year, there were loss-making projects to the value of 294 million. These project losses will be discussed under the operational overview of each business unit. I shall now discuss the performance of the individual business units. Construction and mining's contract revenue decreased to 5.1 billion from 5.3 billion in February 2019, with an operating loss of 418 million compared against an operating profit of 112 million in February 2019. The operating loss includes a provision of 331 million raised for slow-paying trade receivables and project losses of 208 million incurred in the roads and earthworks, civils and mining services divisions. The material loss-making projects in each of the roads and earthworks and civils divisions are complete. The mining services division incurred a loss of 96 million on the Van Gaetfontein mine. The parties have mutually agreed to terminate this project, and we will be ceasing mining operations at the end of July 2020. Subsequent to the year end, a further contract mining project was terminated by the group. This client is disputing the termination, which has been referred to arbitration. The group is confident that the termination was lawful and therefore no provision has been made. Percentage turnover and order book by sector. The yellow indicates the turnover to the end of February and the blue indicating the current order book within the various sectors. Transport infrastructure and water, sanitation and pipelines comprises 72% of the order book. The termination of the two mining services contracts resulted in a reduction of 2.3 billion in the order book. The order book at February 2020 was 4.6 billion compared with 6.5 billion at February 2019. The impact of COVID-19 on economic growth is negatively affecting the order book. Opportunities. Port upgrades in Durban and Cape Town offer opportunities for the marine and civil divisions. Opportunities exist in water and transport infrastructure in South Africa, Swaziland and Botswana. Mining infrastructure opportunities continue to present themselves to the benefit of this business unit. The government's proposed National Development Plan will offer potential opportunities for this business unit. In the short term, there are potential awards to the value of approximately 3.9 billion, and for the next 12 months, projects to the value of approximately 28 billion have been identified. The building business unit's contract revenue reduced to 2.6 billion compared with 3.4 billion in February 2019, predominantly due to minimal certification for work done on the Kusile building project. The operating loss increased to 490 million from 251 million in February 2019, which includes a 462 million provision raised for future costs on the Kusile building project and a project loss in the Gauteng division, which is now complete. The profit of the 48 million of the equity accounted United Arab Emirates operation is excluded from this result. The Mozambique, KwaZulu-Natal and Western Cape divisions continue to deliver positive results. Percentage turnover and order book by sector. 83% of the current turnover was in factories and warehouses and office and commercial sectors. In the current order book, office and commercial, residential, tourism and leisure make up the majority of the work secured. The impact of COVID-19 on economic growth is negatively affecting the order book. Opportunities. This business unit will also potentially benefit from the National Development Plan. Further opportunities exist in the private sector in commercial, leisure, warehouse and factories in KwaZulu-Natal and Western Cape. The Mozambique division's order book is currently under pressure, impacted by the delay in the Northern Province gas fields expansion projects. This division is, however, pursuing opportunities in office, residential, factory, and surface mine infrastructure in the private sector. Buildings order book at February 2020 was 2.3 billion compared to 2.7 billion in February 2019, excluding the United Arab Emirates order book of 658 million against 808 million in February 2019. Just to clarify, the UAE is included in the order book, but due to the fact that it is equity accounted, its turnover is excluded from contract revenue. In the short term, there are potential awards to the value of approximately 3.1 billion, and for the next 12 months, projects to the value of approximately 24 billion have been identified. Mechanical electrical. Due to a shortage of available work, mechanical and electrical's contract revenue decreased to 897 million when compared against the 1.2 billion at February 2019, with an operating loss of 25 million against the 19 million loss reported at February 2019. The operating loss has been impacted by project losses incurred on a project in each of the oil and gas and mechanical divisions. Both of these loss-making projects were completed during the year. Due to the shortage of available work in mechanical and electrical and instrumentation divisions, they have been progressively scaled down. Should current opportunities not materialize, these divisions will require further restructuring. The arbitration matter relating to the cancellation of a petrochemical contract has been postponed due to a fundamental change in the client's defense. A date for the arbitration is yet to be set. At this stage, the financial impact thereof cannot be quantified, and therefore no provision has been made. Subsequent to the year-end, Stefanutti Stocks terminated a mechanical project. The client is disputing the termination, which has been referred to arbitration. The group is confident that the termination was lawful, and therefore no provision has been made. Percentage turnover and order book by sector. The current turnover was a fair split between surface mining and related services and industrial plants and oil and gas sectors. In the current order book, 78% is made up from work in the industrial plants and oil and gas sectors. The impact of COVID-19 on economic growth is negatively affecting the order book. Opportunities in the traditional petrochemical sector for the oil and gas division have substantially reduced due to the current global uncertainties negatively impacting on the oil price. Limited investment into surface mining plant infrastructure projects is negatively affecting the mechanical division's order book, both locally and cross-border. In the short term, there are potential awards to the value of approximately 480 million, and for the next 12 months, projects to the value of approximately 8.9 billion have been identified. This slide is a consolidation of the business unit's actual turnover and current order book by sector. Due to the termination of the two contract mining projects, the group's order book has reduced by 2.3 billion, which has the effect of increasing the percentage of work outside South Africa to 49%, including the UAE. In the short term, there are potential awards to the value of approximately 7.5 billion, and for the next 12 months, projects to the value of approximately 61 billion have been identified. I have already covered the actual performance of the business units earlier in this presentation. However, with respect to the next financial year, this guidance is given based on our current understanding and the forecasted initial impact of COVID-19 on our business. Construction and mining, we expect turnover to reduce with half the operating profit margin as reported at February 2019. Building, excluding the UAE, we expect to have a reduced turnover to the current financial year with a negligible operating profit margin. UAE operations contribution is expected to be less than that of the current year. Mechanical and electrical, we expect to have a reduced turnover with a similar operating loss as reported in the current financial year. Included within head office is the amortization of intangible assets and impairment of goodwill amounting to 55 million. In addition, extraordinary costs for the second 6 months amounted to approximately 43 million. These costs comprise restructuring, advisory, legal, and funding fees relating to the restructuring plan. From a group perspective, for the following financial year, we expect turnover to be down from that reported at February 2020, with an operating loss due to the incurring of extraordinary advisory fees, which will offset the various business units' improvements. The group has estimated the initial impact of COVID-19 on the business to be around 270 million. This estimate is made up of unrecoverable overheads and preliminary and general costs due to lost revenue, loss of profits, unrecoverable overheads, and standing time costs due to project terminations, incurring additional costs with respect to closing out and starting up projects due to the national lockdown, and lower productivity being achieved in order to comply with the restrictions imposed by the required protocols. In an effort to mitigate the financial effects of COVID-19 on the business, application has been made to the Unemployment Income Fund's Temporary Employment Relief Scheme, and some relief has been received for the month of April, which amounts have been paid to all entitled employees. Our May application is still pending. Applications for June and July will be made. With respect to limited duration employees, a policy of no work, no pay was applied. For the month of April, leave pay and 13th checks were utilized for salaried staff and permanent wage earners remuneration. For the months of May, June, and July, salary sacrifices were implemented on a sliding scale, starting from 10% for lower earning employees to a maximum of 33% for higher earning personnel. In addition, for the same period, non-executive directors, restructuring advisors, legal advisors, and forensic specialists have all discounted their fees up to 33%. Due to the majority of the South African operations not having worked in April, a decision has been made to reduce the length of the December builders' break. During the month of April, in South Africa, most projects had been stopped with the exception of certain contract mining projects which were deemed essential. In Botswana and Eswatini, projects had been stopped with the exception of one project each which were deemed essential, whereas in Mozambique, only one project had been stopped. In Zambia and the UAE, all projects were operational. As can be seen from the graph, year-on-year effect was a reduction of 63% in hours worked. During the month of May, in South Africa, work had commenced on approximately 60% of the projects. In Botswana and Eswatini, work had commenced on all of the projects. In Mozambique, one project remained closed. In Zambia and the UAE, all projects were operational. The reduction in hours worked was 51%. During the month of June, the majority of South African projects had resumed. The effect on hours worked was 33%. We are constantly monitoring and tracking all COVID-19 cases within our business. As at the end of June, we had had a total of 20 positive cases, of which 2 are subcontractors, and we had had 12 recoveries. Currently, Limpopo province has registered the most positive cases of 8 employees. In order to observe social distancing, a significant number of our office staff continue working remotely from home. I would now like to hand you over to Antonio for the financial overview.
Thank you, Russell. These results are in line with the trading update released on SENS on 29 May 2020, indicating earnings per share and headline earnings per share to be a loss of between R6.10 and R6.50. These results are characterized by the following factors as highlighted by Russell. So in summary, a trading environment that remains challenging, an additional IAS 37 provision raised for the Kusile building project, specific provisions raised for slow-paying receivables, project losses, and continued pressure on working capital due to poor liquidity in the market and the funding of the Kusile building project results in the group continuing to experience short-term liquidity pressures. Some financial indicators. Contract revenue, 8.6 billion, with an operating loss of 1 billion. Operating loss, excluding the IAS 37 and slow-paying receivable provisions and impairment of goodwill, is 187 million. Headline loss per share of 622 cents and 148 cents excluding the provisions and the goodwill impairment. Moving on to the statement of profit and loss. Contract revenue for construction and mining, building, and mechanical and electrical decreased by 200 million, 800 million, and 300 million respectively, resulting in an overall reduction in contract revenue of 1.3 billion. The EBITDA loss has been impacted by the raising of an additional IAS 37 provision of 462 million relating to the Kusile building project. The group is actively pursuing its contractual rights in terms of the contract, and the raising of specific provisions for slow-paying receivables of 331 million due to less frequent and reduced payments being received from certain local and cross-border clients since the beginning of the year. The recovery of these amounts will continue to receive management's attention. With the exception of one of these debtors, none are in dispute. However, the timing of the recoveries remain uncertain. When they occur, they will positively impact on the group's performance and liquidity, and loss-making projects, as mentioned by Russell, of 294 million. The depreciation charge has remained relatively consistent at 217 million from 211 million of the comparative year, which includes an IFRS 16 right-of-use charge of 62 million. Due to the ongoing reduction of work in the local market, coupled with losses on certain operations, goodwill and intangibles of 55 million have been impaired during the year. This all results in an operating loss of 1.033 billion. Should the IAS 37 and slow-paying receivable provisions and impairment of goodwill be excluded, the operating loss is 187 million compared to the operating profit of 105 million of the prior year, excluding the IAS 37 provision of 263 million raised in that year. The UAE operation contributed 48 million, which is more reflective of normal trading as opposed to the 66 million of the comparative year. Due to the liquidity constraints, interest earned has reduced to 30 million and interest paid increased to 126 million. This includes an interest accrual for the Kenyan tax authorities of 18 million. Due to increased funding requirements, interest paid will increase in the next financial year. The tax charge is impacted by the IAS 37 and slow-paying receivable provisions, project losses, impairment of intangible assets, varying tax rates of cross-border jurisdictions, and the non-taxable contribution from the UAE operation. The group did not provide for a deferred tax asset on these provisions and project losses. In addition, an accrual for a potential tax liability in Kenya has been raised. Group entities operating in foreign jurisdictions are continuously subjected to tax audits by local revenue authorities as part of the enforcement processes. The Kenyan Revenue Authority is performing an audit on Stefanutti Stocks Kenya Limited for the years 2013 to 2018. An assessment has been received in September 2019 for the 2013 tax year, for which an appeal has been lodged. The matter remains ongoing. The audit is ongoing and assessments for following years have not been issued. The total value of the assessment, including interest and penalties, amounts to 43 million. Loss after tax for the year has been impacted by the IAS 37 provision, slow-paying receivable provisions, and impairment of goodwill. All this results in a headline loss per share of 622 cents. Excluding the IAS 37 provision, slow-paying receivable provisions, and impairment of goodwill, The headline loss per share is 148 cents. Moving on to the statement of financial position. CapEx spend for the year is 99 million, excluding 305 million IFRS 16 right-of-use assets. Of the traditional CapEx, 32 million is for expansion and 67 million for maintaining operations. Due to the termination of the contract mining projects, as referred to by Russell, unutilized plant and equipment capitalized under IFRS 16 will be returned to the suppliers as it is no longer required. Therefore, of the 305 million capitalized, 272 million will be reversed in the following financial year. Due to clients delaying the certification of work, work in progress has increased from 507 million at February 2019 to 640 million. There has been a 4% decrease in trade accounts receivable. However, days in debtors have increased from 68 days at February 2019 to 75 days, which exceeds our target of 60 days. As mentioned earlier on by Russell, provisions have been raised for slow-paying receivables, where payments are less frequent and have reduced in value since the beginning of the financial year. Ongoing discussions are being held with these clients to resolve these outstanding payments. With the exception of one of these debtors, none of the remaining amounts are in dispute. However, the timing of the recoveries remain uncertain. When they occur, they will positively impact on the group's performance and liquidity. Net cash on hand of 741 million has been impacted by delayed payments for customers and the temporary funding of the Kusile building project, which continues to impact on the group's short-term liquidity pressure. On 1 July 2020, the group entered into a term loan agreement with its lenders on standard terms and conditions applicable to this type of funding, terminating on 28 February 2022. Total funding received to date is 1.252 billion of the estimated 1.256 billion required, which includes an estimate of the initial impact for COVID-19 of 270 million. The funds received have been utilized to stabilize the operations, temporarily fund the Kusile building project whilst the group continues to pursue its contractual claims and compensation events, and evaluate an appropriately balanced capital structure for the remaining business. The cost of funding, including arranging fees, is 5.4% above the prime lending rate. The lenders have agreed to provide continued guarantee support for current and future projects being undertaken by the group. The restructuring plan has been approved by the board and lenders and is anticipated to be implemented over the financial years ending February 2021 and February 2022, coinciding with the termination of the term loan agreement. To the extent required, shareholder approval will be sought for relevant aspects of the plan. The funding provided by the lenders has assisted in relieving the group's liquidity pressures, even though current liabilities still exceed current assets. And as a consequence, material uncertainty exists that may cast doubt on the group's ability to continue as a going concern in the short term. However, having converted the short-term funding agreement to a term loan on 1 July 2020 and on the basis of successfully implementing the restructuring plan, the directors consider it appropriate that the group's results for the year be prepared on the going concern basis. Moving on to the liability side of the statement of financial position, total interest-bearing liabilities have increased from 637 million at February 2019 to 1.51 billion, primarily due to the additional term loan funding of 839 million received by February 2020 and 300 million IFRS 16 rental plant assumed liability. As mentioned earlier, due to the termination of the contract mining projects, unutilized plant and equipment capitalized under IFRS 16 will be returned to the suppliers as it is no longer required. Therefore, of the 300 million assumed liability, 272 million will be reversed in the following financial year. The debt-to-equity ratio deteriorated to 207% from the 37% reported at February 2019. Excluding the IFRS 16 liability, the debt-to-equity ratio is 166%. Equity has been impacted by the raising of the additional IAS 37 provision and slow-paying receivable provisions. Trade payables, accruals, and other current liabilities have reduced from 2.1 billion to 2 billion. Excess billings over work done has in total increased by 178 million to 1.349 billion. There has been a 247 million increase in total provisions from 760 million at February 2019 to 1 billion, which includes the additional IAS 37 provision of 462 million. Moving on to the statement of cash flows. Cash consumed from operations is 314 million, which is in line with the poor trading results of the operations excluding the IAS 37 and slow-paying receivable provisions. A total of 437 million was invested into working capital as opposed to the 246 million generated in the prior year. Once again, I've split investing activities in the old way of preparing the cash flow statement, split between CapEx acquired to maintain and expand operations and other investing activities. Other investing activities predominantly comprises the sale of plant and equipment. A similar adjustment was made to financing activities with 601 million of net debt being raised during the year. All in all, there's been a reduction in cash from February 2019 of 140 million to 741 million. In conclusion, from my side, successfully implementing the restructuring plan and focusing on a positive resolution with respect to the Kusile power projects remain the top priority. I will now hand you back to Russell to close the presentation.
Thank you, Antonio. We will now cover industry-related matters. With respect to the civil claim received from the City of Cape Town for the Greenpoint Stadium, a trial date had been set for the first quarter of 2020. However, on request of the client, this trial has been postponed. The matter will now be dealt with in arbitration, which is anticipated to be heard during February 2021. The group remains confident it can defend this claim. With respect to the voluntary rebuild program, Stefanutti Stocks and the other signatories to the settle agreement are facing several challenges regarding the implementation of the agreement. The parties have requested a supervisory committee meeting with Ministers of Rural Development and Land Reform, Economic Development, Public Works and Transport to resolve these challenges. This request was made in May 2019 and we have not yet received a response to our request. The lack of sincere communication from government is the biggest challenge facing the successful implementation of the settlement agreement objectives. COVID-19 has introduced a new challenge with respect to the settlement agreement, and we are currently engaging with government to negotiate a COVID-19 payment relief for 2020 and delay this payment. The group continues to be negatively affected through disruptive and unlawful activities by certain communities and informal business forums in certain parts of South Africa. In conclusion, our focus is on the successful implementation of the restructuring plan, pursuing a favorable outcome from the processes being undertaken on the Kusile power projects, drive the collection of all outstanding slow-paying receivables, continue our focus on reduction of loss-making projects, and return the group to profitability. This brings us to the end of our presentation. We are now available to respond to any questions that you may have. Thank you.